Over a single 12-month period, trading volume across major prediction markets accelerated in a near vertical line, surging from $1.8 billion to $24.2 billion. The operators of these platforms pitch them as democratizing forces. The promise is that anyone can log on, monetize what they already know, and tap into the objective wisdom of the crowd. But platform data reveals a rigid mathematical reality. Despite the marketing, over 70% of everyday retail participants consistently bleed capital. This chart shows the distribution of wealth on the largest network. Just 1,000 specific accounts capture 67% of all platform profits. Viewing those 1,000 accounts against the ecosystem of 2.3 million total users, the asymmetry becomes glaring. Those top accounts don't possess superior foresight. Their dominance is the result of quantitative trading algorithms exploiting structural platform mechanics. Prediction markets are not operating primarily as crowd knowledge engines. They operate as highly efficient wealth transfer mechanisms, routing capital from manual retail traders directly to automated institutional firms. To trace how that capital moves, look at the market's fundamental unit of trade, the binary event contract. Contracts are priced on implied probability. A contract trading at 41 cents mathematically represents a 41% chance of occurring. At expiration, it undergoes binary settlement, paying exactly $1 if the event happens, or collapsing to $0 if it doesn't. The way participants navigate this binary outcome splits into two distinct operational models, the retail loop and the institutional loop. The retail strategy relies on directional speculation. A user consumes news, relies on intuition, and manually buys a single side of a contract hoping for a payout. This manual, directional guessing puts retail order flow on a direct collision course with algorithmic systems that buy and sell simultaneously. Because the pricing of a contract is strictly mathematical, algorithmic traders can identify exactly when human excitement causes retail users to overpay for them. The flaws in retail logic are most visible in mention markets, a high-volume category where users wager on whether a public figure will say a specific word during an appearance. This scatter plot compares a contract's listed price against how often it actually pays out. It illustrates a phenomenon called the long-shot bias, a psychological trap where retail users, driven by the thrill of a payout, systematically overvalue unlikely events. Across tens of thousands of trades, contracts priced at a 50% probability only pay out around 40% of the time. The mathematical consequence is severe. Retail participants are consistently paying 50 cents for an asset that is structurally worth 40 cents. They lock themselves into a negative expected value before the event even occurs. The friction between manual expectations and rigid market rules routinely wipes out retail capital. Consider a user who wagered $41,000 on a single mention market tied to the artist A$AP Rocky. The parameters were binary, a complete liquidation of capital if the artist failed to say the word rapper during a late-night television appearance. The artist did say the word on stage. However, the segment was edited out of the final television broadcast. By the strict criteria of the market settlement rules, only the broadcast mattered. Operating manually through simplified app-based web interfaces, retail users frequently misunderstand or ignore these rigid technical conditions. The structural trap triggered immediately. The user's entire $41,000 stake evaporated to zero. The retail loop's reliance on manual intuition and the excitement of the wager guarantees capital depletion in a zero-sum, statistically rigorous environment. The institutional loop is entirely devoid of intuition. It is operated by quantitative firms deploying institutional-grade hardware. These entities act as market makers. They continuously quote both the buy and sell sides of an asset, remaining mathematically neutral on what actually happens in the real world. While a retail user makes a single manual click on a user interface, algorithms execute continuous streams of automated commands through the platform's API. Maintaining this structural edge requires immense capital expenditure, with some firms deploying hundreds of thousands of dollars annually on live data feeds and co-located servers to ensure zero latency. The operational velocity is staggering. An algorithm will modify its bid and ask limits dozens of times per second. This speed allows institutional models to continuously step in front of slower, manual retail limit orders before a human can even react to a price change. Their goal is spread capture. By providing both the buy and sell price, they systematically skim fractional pennies off the gap between retail buyers and retail sellers on every transaction. Risk is managed through sheer volume. Algorithms dynamically adjust their exposure across tens of thousands of daily microtrades, ensuring the firm is never overexposed to a single directional outcome. Retail traders risk everything on a single binary bet. Algorithms harvest incremental profits regardless of who wins the bet. These high-frequency operations are purpose-built to act as the direct counterparty to retail's dumb money. Institutional market makers are not predicting the future. They're simply harvesting the mathematical mispricing generated by retail participants driven by the long-shot bias. Prediction platforms actively market the fact that they are peer-to-peer exchanges. Because users trade directly with each other, there is no traditional house setting the odds to take an edge. But an order book exchange faces a structural dilemma. Without constant liquidity and tight spreads, users can't execute trades and the market freezes. The platforms need institutional volume to survive. This flowchart illustrates the solution: liquidity rebates. It is a structural financial incentive where the exchange actively subsidizes algorithmic market makers to provide continuous pricing. Elite quantitative trading firms receive fee rebates and are frequently paid directly by the exchanges themselves, specifically to maintain depth in the order books. These rebates generate an insurmountable mathematical advantage. Institutional algorithms are being actively funded to execute the exact microtrades that drain retail capital. This guaranteed structural dynamic is highly lucrative, and it is now attracting the attention of massive, high-volume quantitative trading firms from traditional finance. Federal regulatory bodies have articulated their oversight over these platforms, treating them as regulated financial derivative tools rather than simple offshore gambling operations. That brings us back to the initial data point: a single 0.1% of users holding 67% of the profits. That extreme concentration is not an accident. It is the intended outcome of API speed, spread capture, and exchange liquidity subsidies working in tandem. Prediction markets do not have a traditional house, but the structural advantages granted to algorithmic market makers allow them to assume that role, engineering a mathematically guaranteed monopoly over retail order flow.